Thank you very much, everyone. Again, it's wonderful to be with you on a beautiful Wednesday afternoon. Uh, I can't believe, Christmas is down the corner. So we like to continue our classes. And as you know, in the past, we've been working on the option strategies, but I thought it would be good to work on more of a setup and indicators to help us to facilitate having the setups for our like option strategies. So today I'm gonna speak about something which has been we've talked about in the past, and it's one of my favorite indicators actually, which is called squeeze or TTM squeeze. And basically, I'd like to go over what it is and how we can apply it. So again, the squeeze. So what is a squeeze and why I like this indicator? As you know, I don't like to use too many indicators. It becomes confusing actually, and it complicated and gives us actually doubts about our entry and exit. So I like to pick and choose few which are mathematically oriented, and the squeeze is one of them. So what is a squeeze? Why do we use the squeeze? What are its components? What is it made of? And how do we use it? And as far as the time frames, can we use it? Does it apply in the long term, short term? And we will go over all of those. So basically, as you know, the markets really trade most of the time sideways. They are mostly range bound. Although we look at a lot of times when we're in the trending markets, we only emphasize that, but majority of markets, and it's not just the equities, they're majority of them, they're choppy. So they are within a range, and that's about 80% of the time. 20% to 25% of the time, they actually start making their directional moves. So what this squeeze is based on is that it works on the price compression. And it says this energy is coiling, it's compression, and then it breaks out. So we want to be on that side. We want to see when that explosive move's happening, we want to be part of that explosive move. So with using the squeeze, we can actually identify when those moves are going to happen and in which direction. So one of the things that I like about the squeeze is it gives us which way is the trend, but also allows us to have our exit and entries. And also with the reversals, we can do even the opposite. And entry, while we are exiting, we can actually even enter to the other side of reversal. So because of that, because we know the strategy and what indicator is telling us, we can actually apply the option strategies that we have worked on in the past. And this indicator helps in many ways. For instance, we can use the straddles, we can use the strangles, we can use vertical spreads. We can actually even use iron condors and butterflies. And so there are many different ways that this is helpful in again, guiding us the right way. So before we start going actually in the squeeze, I thought there's about four terminologies I want to be comfortable. Probably most of you know about them, but I thought it's a good idea to review them because that's what the squeeze is based on. The first one is the average true range, and basically it's a technical analysis indicator. And what it does, it just goes back. Majority of time, you can pick and choose how many days you go back. We usually use the 14 days. Majority of the platforms and a lot of the websites, they actually use the 14 days. And the average true range, it allows you to know what range it has been, let's say in this case, in 14 years, the days, the highs and the lows. And then it sets up a range which it lets you know what the movement has been. And based on that, you can actually do your stop losses, you can actually do your targets, you can do your exit strategy. So average true range is very similar in some ways to Bollinger Bands, except what it is, it's more of a range bound, it's not a standard deviation of the volatile dynamic part of things. So with average true range, how we can apply and make it even more helpful is something called Keltner channels, which actually it allows you work with the deviation from the mean of the past 14 days. So it comes out like a bands, and these bands are more predictable and more steady than, let's say, we will talk about, let's say, Bollinger Bands. So with Keltner channels, you can have the boundaries, and you can have, again, you can see your have the exit strategies, you can have the support and resistance, you can have the extensions. So the Keltner channel is important because it allows you to have the guidance of the movement of the range. So with that in mind, we've been very familiar with Bollinger Bands. We've worked a lot with in the past. Majority of time, it uses a 20 bar. If it's daily, it looks at the 20-day moving average. And based on that moving average, it uses the variance and then the standard deviation of that, which we use, as you know, the one standard deviation contains 68.4%, and the two standard deviations, about 95% of the time, the prices range is contained in those boundaries. So Bollinger Bands are very helpful because, again, they're statistically oriented. As I mentioned before, in the futures market, we use 18 days rather than 20 days. But for our discussion with the squeeze, it would be used a 20 bar or 20-day if you use it daily. So basically, these are the important things that I want to understand. This is what squeeze is made of. We got Keltner channel, which works on the ATR, Bollinger Bands, which works on the moving averages and the standard deviation, in this case, two standard deviations. And the last but not least, part of this is the momentum oscillator. So with the momentum, it's an oscillator that allows us to see how fast an asset is moving, an underlying asset is moving, security is moving, and at which direction. So again, with our purposes, it goes back to the 14. We use the 14 and 12 average. So with that, it allows us to find the direction of the movement. So we got really three components. We got Keltner channel, we got Bollinger Bands, and we got momentum. So let's put them together and see how this squeeze was created. So let's work on, this is a chart from my trade station, and basically what you can see from, so I made this, and that's using, again, the Keltner channel, which is in blue. So the Keltner channel, again, both of them use a 20 bar moving average. In this case, this is a daily chart of the Microsoft. And with the daily chart, we have a 20-day moving average, which is in yellow. And the blue color here, the bands, are 1.5. So the ATR goes 1.5 times of average daily range. So this is what John Carter has used for his TTM Squeeze. So we'll use that. My regular Keltners, I usually use 2 standard deviations, or 2 ATRs in this case. You can see the Keltner channel is more predictable in some ways because, again, we are using average true range, and it's not as volatile as the Bollinger Band, which works on the standard deviation. So the blue bars, the blue bands are Keltner. The red, in this case, bands are Bollinger. So the whole idea is when the volatile bands, which is the Bollinger, is resting inside the Keltner channel, which is the more stable one, that means this is quiet time. There is something coiling, something is going to happen. And in this case, you can see with Microsoft, as you notice here, the Bollinger Band, which was outside, has crossed and come inside the Keltner channel. And as you can see, the bands are really getting closer to each other. The Bollinger Bands are narrowing. So this is a quiet time, as I mentioned. So that's what is called squeeze. The squeeze is these bands are squeezing. And on top of that, Bollinger Band is going inside the Keltner. So right now we know there is that quiet time. So because of that quiet time, we can predict something is going to happen in the future with all that energy which is coiling, but we don't know which direction. In order to find out about the direction, you use the momentum oscillator. Now, you could use RSI, you could use MACD, but the momentum oscillator, this one is a pure momentum, which again uses the 14 bars and 12 average. So what happens is it tells us what is, as far as the strength of the price movement compared to the past, and what happens and how strongly it's moving on that direction. So when we are above the 0 bar, that means the buying pressure is on, and as we're getting higher and higher, there's more momentum helping us to even push the prices higher. In this situation, so when it's positive, that means the buyers are more in control. When it goes to negative, when it goes below 0, then that means there are more sellers are in control. So with these tools right now, this is the foundation of the squeeze. So right now, we actually do have squeeze in Microsoft with the bias a little bit to the high. So you can see we are kind of flattening. So that tells us there's not a lot of conviction, but it is still to the positive. In the meantime, what is happening is, again, the bands are closing each other. So let's transfer that and let's go to another service, which is ThinkorSwim. Now, ThinkorSwim it already has the TTM Squeeze already built in it, and it's for free, and that's the reason I want to show the ThinkorSwim. Now, if you want to have that in other services, platforms such as TradeStation, there's a monthly fee. For instance, for the squeeze alone, just a TTM Squeeze, you have to pay $50, for instance, to have it on the TradeStation. With ThinkorSwim, all of the John's indicators are free, which is wonderful. So let's translate what we just saw with the Bollinger Bands, the Keltner Channels, and Momentum. Let's translate that to Microsoft daily chart in the ThinkorSwim. So with ThinkorSwim, as you can see, this is what is called the TTM Squeeze. So there are a few components about it, so we're going to go over them. And right now, when you see these red dots, when there's red dots, that's the quiet time. That's when there is something coiling, so that's what the red indicates. When it turns to, and we call that Microsoft is in squeeze. When the red turns to green, the color changes. That means we call it the squeeze has fired. That means there's a movement, and the movement is going one way or another. We don't know, and that's what we use these light blue bars or the red bars. So if we turn from red to green and it starts, we call it fired, because it's blue color, it's above the 0, that means we are to the long side. That means the buyers are more in control. In some situations, you don't have it, but let's say when the bar turns to red, that means the sellers are in control. So basically, this is the whole complete package of what we saw with the TradeStation, with the Bollinger, the Keltner, and Momentum. All of them are in one place. So if you recall, we mentioned that Microsoft just went into the squeeze, and that's what it happened. You can see it's in the red dots. Now, I also mentioned, you noticed the momentum was kind of flat. And guess what? We don't really have a very overwhelming bars here. So we are really staying, we don't have really any direction at this moment. So how do we use these now? This is on the daily. So the interpretation for Microsoft right now is that there is no really direction. There is not much play with the squeeze. So what we want to wait for is for this one of these green dots to appear. I go beyond that. As you noticed last week, we talked about linear regression analysis, and which is this. So what I like to do, I want to combine 3 or 4 complete indicators, and based on that, we can make a judgment. Okay, so let's go one step at a time. Number one, we see the linear regression allows us to know where is the best fit data, or where is the mean, which is this yellow line. And you can see Microsoft is right around that. So again, no guidance. We would have, if it was oversold and it was in the second standard deviation, then that would have given us a little bias. But right now, we don't get any bias. So this linear regression analysis, again, is free. You can get it from the ThinkorSwim, which I will show you how we get it. So that's one indicator so you can use. And also you can see the extension of them. For instance, here, what happened, you notice we're in the second standard deviation right now. And then you notice the red bar, it turned to yellow. And what that means is the red bar tells us, obviously there's a selling pressure. As soon as it changes the color, that means that the exhaustion of the sellers. So let's put a couple of things together. Right now, we have the red has changed to yellow. So that means exhaustions. At least if you had shorts, this might be a good place to actually cover your shorts. If you had a put option, this might be a good place to cover your put and sell it. For 2 reasons. Number one, we are in the second standard deviation. Number 2, the color has changed. Let me show you the third service, which is free for you, again, with the ThinkorSwim, which is, again, with the TradeStation, you have to pay this $30 a month, both for this. And the third thing that we talk about is a TTM trend that, again, it comes with. And what does that mean? We will speak about candlesticks. You've noticed the candlesticks are red, green. We talk about, there's all different kinds of, again, interpretation of the candlesticks. What this TTM trend does, it kind of combines the momentum with that candle. So visually, when you look at it, you don't see the green and red. Basically, when you look at it, as long as it's blue, again, this is the TTM Valley, as long as it's blue, that means the buyers are in control. So in this situation, we have light blue, we have this blue, and that means we're in control. The minute that it changes to hollow red, that means there is a change of pattern. The sellers are coming to the control. And when it's just to solid red, that means the sellers are in complete control. So look what happened. We went to the second standard deviation. The color, that time, the color of this blue bar, the light blue bar, changed to the darker. Again, that meant that the momentum for the buyers is slowing down. This is a good time, maybe cover your longs, sell, go out of them. If you had, let's say you had bought calls on this Microsoft, maybe this is a good time. When we hit the second standard deviation, our LRC, when the color changes, on top of that, now the color is changing to hollow red. And then we're getting more momentum. You can see the momentum is losing on this side. The selling is getting more as far as the strength of that. So now we combine really 3 kind of indicators. So we have the LRC, we have the squeeze, and we have the TTM Valley. I'm going to offer you the fourth one. Again, that's another one, $30 a month registration charges. So right now, between the fourth one is like $140 they charge you, getting them for free every month. So this is called TTM Waves. And what the waves does, they look at the, they call it A wave, B wave, C wave. He looks at the relative strength of the pricing on a short-term, intermediate, and long-term. So like any other indicators, when it's above zero, that means there are more buyers. And when the colors change, again, it's all about visualization, right? So in this situation, what we want to do, we want confirmations. We don't want contradictions. So I will get into a position when I do have the confirmations. As you know, I'm very big on linear regressions, the Bollinger Bands. I like that mathematical or statistical backup. So when I see something like this, and when I see there is this dark blue, which is more of a loss of momentum, in this case, to the loss of momentum of the buy side. When the light colors come, that means there's a momentum to the buy side. So if I take a look at this part of our trade, if we were getting into trade, now I have this is the second standard deviation. The full red color is changing to hollow. That means the loss of momentum for the sellers. This red bar is changing to yellow, and this dark blue bar is changing to light blue bars. So basically, this is, again, it allows us to be, again, it's about probabilities, and that allows us to be more in control of our position. At this time, as you can see, we really don't have any confirmations. So I am looking at this. As I mentioned, the LRC is not helping me. This is a squeeze, it's not helping me. And this is, although it's still in a more positive, still the strength of the buyers are there, and they've been there for a long time. If you go back to April and May, it has been there, but there is no confirmation what I could do. So let's go and just again, just let you know what these bars mean. So when there's a red dot, that means we are in squeeze. It's a quiet time. Something could happen. Green dots, the squeeze has fired. It's ready for action. If it's depending on the bars, that's the direction you're going to take. If there's red bars, that means the momentum is to the downside. If it's light blue bars, it's momentum to the upside. Once this red bar changes to yellow, that means the move has already had its momentum. It's time to lighten up. You don't have to, in this case, just go and buy it, but be aware there is less of pressure in selling, so it's possible of reversal. The same thing if it's a dark blue, again, the buying pressure has stabilized and it's run out of steam. Maybe it's a good time to possible reversal. So what else we could do? I mentioned too, you can use them in the different time frames. So one of the main reason for the TTM is really actually the daily. It works great. But you can actually even use it for 60 minutes, 30 minutes, 5 minutes. And basically in this situation, let's say I want to use this 60 minutes. So with 60 minutes, you can see, again, at this time, we are changing this is the wave, it changed the color. This has changed the color from from red to yellow. We are in the one standard deviation. This red is changing blue. So this is more of a short term, not even swing trade. You could actually use a swing trade. And in this situation, you're basically have the odds in your favor with combining these four that, okay, this is a good place, maybe I can get in. So we had one squeeze dot, and then actually we got the squeeze fired to the upside. Now, what happened is, one thing you have to remember, if it toss, it has extended hours and overnight. So perhaps you can see there's not much volume. So sometimes it gives us a little, I don't want to call it a headache, but it just visits some quiet time. But these are where I want to really emphasize. So you can see what happened was basically we went to the positive. We could have gotten here. We are hitting the second standard deviation, and this, the blue color is getting solid here. And basically there is a little slowdown. So basically this is maybe a good time to at least lighten up on your positions. And guess what happened? After that, we changed the from the light blue to dark blue, and this already was filled dark blue. That tells us that the trend is changing. And when the red comes, red candle, that's our TTM value telling us, but basically this the sellers are getting more momentum. So this is on 60 minutes. So how are we going to use them? I want to use the 30 minutes. Let's say you're even more shorter term, and let's apply that 30 minutes on Microsoft again. We go back, the same ideas. We had a squeeze here, and if you notice, then we went to green, and green dots mean time for action. Now, again, this is 30 minutes, so very short term. You're going to be in it, but you can see that really after a little bit, and it kind of fizzled out. So that's why it's important to have the confirmations. So there's 2 points I want to make. Number one, time-wise, I will start with longer term, so on a daily basis. So that's my anchor, that's my guiding light. So if it's in the squeeze, I want to watch that to see when it's going to go turn green. The second part, then I go to 60 minutes. Once that turned green, I want to make sure the 60 minutes confirms that. So I wait for the 60 minutes to get green, and even 30 minutes. Usually under 30 minutes, you can use 15 minutes, you can use 5 minutes, you can even use 1 minute. And depending on your length, I mean, if you're doing futures market, for instance, maybe you want to use that. But if you're doing stocks and options, my favorite time periods are the daily and 60 minutes, and the lowest will be 30 minutes, because otherwise you're going to have a lot of choppiness in a sense, because you will get a lot of signals. So that's one thing as far as, again, the confirmation of times. The second thing I want to understand is usually the red could be 1, 2, 3, and 10. Sometimes you are going to be in long squeeze. It's the green dots that you want to follow. Usually the movement lasts 8 to 12 bars, about 10 bars. So what happens in this case, we go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You can see the bars actually changed, and the momentum is really running out of steam. Here again, we had a little break. Again, we continued. So the most of the juice you're going to get out of these green dots are about 8 to 12. So if you're doing on a daily basis, then the signal is going to be good about 10 days, for instance, 8 to 12, let's say 10 days. If you're doing it on an hourly basis, it's good for about 10 hours. If you're doing it on a 30-minute, for instance, it's good for 5 hours. So you can, based on that, so it's about 8 to 12 bars. That's what we found out works the best. Another thing you could do, if you want to be an investor, you have a long-term outlook, but also you want confirmation from daily. I found weeklies work very well with the squeeze. And again, I'm using Microsoft, and look how long we've been in this squeeze. So there's a lot of energy again being coiled. We had a run out of our momentum on the buy side. Our waves still telling us it's still on the positive, although this week we turned to dark blue. We are not complete done with the week yet. So how we can apply this knowledge that on a weekly squeeze there's something going on, and this is where maybe based on your analysis, maybe you can look at something like straddle, maybe Overman strangle. You look at, is there any movement? We don't know which way, but maybe there is something that's going to come out in the next few weeks. The earnings have already been here, so there's not earnings that are not coming due for a while. So this is quiet time. Maybe we can go look back to our, our videos on straddle and strangle. Maybe you can look at the pinning strategy, and that's when I would use the daily and 60 minutes and see, is this a good time? Maybe this is a quiet time. Maybe we can do a butterfly based on that pinning strategy. So that's how squeeze can become very helpful. They can give you the guiding light. So how do we add this? So we go to the charts. We already know that, but how do we add these indicators? Let's say this is the first time you are getting familiar with the squeeze. So basically, again, you go to the studies. You can either do add or basically go with the studies, and you can add one of the ones that in this case is John Carter studies. So when you do John Carter studies, basically you add the TTM squeeze. You add that to your chart. I would definitely recommend to do the TTM LRC. That's your linear regression. So you can add that. If you like, you can add these two as well. The TTM trend, which is the colors. As you can see, it goes from hollow blue, dark red, hollow red, which again allows you to know the direction and the strength. So visually, you know the buyers are in control because it's the blue color. And then the TTM wave is this, which allows you to look at the strength of the short term, intermediate, and long term of the prices. So when we look back in this situation, how long this has been going on. So this is how you can add the TTM to your charting, ThinkorSwim. You can also have it on TradingView. They do allow you to do that. You have to talk to them, and most of them are available, but they're all for fee. John had a close connection with Tom Sosnoff when he started the ThinkorSwim, so I think that's one of the reasons it's free on this charting. So the other thing is I want to show you is, okay, so on TradeStation, I don't have it. So I have my own, again, my Bollinger and Keltner channel. So I just want to show you my workstation. So visually, the way I've set it up, I've set up my charts based on monthly, weekly, daily, then I have 60 minutes, 30 minutes, and then I have 5 minutes if I want to do futures. So this is my setup. You can do exact same thing with ThinkorSwim. You can set up your grid on like the 4 grid and do a daily 60 minutes, 30 minutes, or you can do weekly, daily 60 minutes and 30 minutes. So I just want to share that with you. So as you know, I like the 7 ideas. So I thought the criteria which we visited in the past, just summarize what we've talked about is 7 squeeze criteria you could use is number 1, knowing that this is a trend continuation indicator. So basically one breakout, the whole idea is gonna go up and it's gonna avoid the choppy markets when you get to green dots. And the time frames works in a lot of time frames, but as I mentioned, I like to have the confirmation. If I'm using weekly, then I want to have as my anchor. I want to use daily and 30 minutes or 60 minutes. If I'm using daily 60 minutes, 30 minutes. As I mentioned, I usually don't like to go below 30 minutes or under 30 minutes. So the other thing is like today, for instance, the general market direction, you want to make sure it confirms. Most of the time, obviously, the markets lead us. So if it's bullish, that gives us more confidence in our position. So general market directions, make sure that prices are not too extended. So as you recall, that moving averages, when we go so far away from the 20-day moving average, And then I use the linear regression channel. When we go to the 2 standard deviation, that tells me this extended. So the yellow light or red light comes on, and maybe I should lighten up my position. So, and as the momentum we talked about, that's when momentum actually goes above 0 and it's shifting. So the shifting would be, if you're using the bars, maybe it goes from red to yellow. It just gives you the heads up something's gonna happen. I also, if you like the Fibonacci's, it's good to know that you could actually use your Fibonacci extension to actually get at your target price. So if you want to use, so we use the Fibonacci, we go 0, 100%. As you know, like 50 to 61.8 is pretty important. But if you want to go like the extension of target price, what you could do, you could look at when the squeeze has started. So you look at the length of the squeeze, and then we go from the high to the low, and part of your Fibonacci numbers, you can add, besides 100%, you can put 127.2, 138.2, you can put 1.5, you can keep going. So in this situation, 127.2, that will give you a target. And last but not least is just be ready before when the squeeze has fired. When the bars are changing colors and they're getting narrower and narrower and getting smaller, that gives you heads up that, you know, it's ready to get fired. So John himself, John Carter, he doesn't wait for actual squeeze to be fired. So he gets on ahead, and you can maybe even do position sizing. You can add some more as the confirmation comes in, but you can start gradually adding if you like. So, as you know, every week on our market analysis, I like to scan some of these stocks. Last week, for instance, we did the NASDAQ 100, and these tell you, for instance, we had the 7, like Microsoft was one of them, which you could see. Actually, that was in squeeze. Gilead was in squeeze. NVIDIA is in squeeze. So these are some ways you can find the candidates. And in this situation, I like to provide it every week, so with different indexes. So we can go to S&P 500, or we can look at Russell 2000. Last week we chose NASDAQ 100. And with that in mind, I think that's the end of our presentation. I hope it was helpful. I hope it kind of cleared a little more about this mystery of a squeeze, and hopefully it gives you a little more confidence to use it for your more profitable trading in the future. That in mind, I thank you very much, and I will start our Q&A, and be happy to answer your questions.